Now with the Federal Reserve Bank's latest pause on interest rate hikes, lots of people have questions as to what does this actually mean for the economy? Does this Fed pause now mean that our economy is set to boom, or are we going to see more economic pain ahead? Here's what Deutsche Bank had to say. The title of this article is Recession or No Recession: Why Deutsche Bank Says an Economic Downturn is 100% Inevitable. Notice what they said. They didn't say 90% inevitable, 99% inevitable. They said 100% inevitable. The reason why Deutsche Bank says that we're going to see more economic pain ahead is because of 5 risk factors that they point out in this article. Number 1 is the higher interest rates and the impacts of the higher interest rates. Number 2 is consumer spending and the future slowdown in consumer spending. Number 3 is going to be a rise in future unemployment. Number 4 is slowing economic growth. And number 5, which is, of course, inflation. Starting with what Deutsche Bank said on interest rates. Obviously, we've seen interest rates rise from 0 to 5 and some percent over the last year and a half. And Deutsche Bank essentially says that, well, for one, there's going to be an impact of these higher interest rates that we have yet to feel. And then they went on to say this: the inflation that we see was induced largely by expansive fiscal and monetary policy, and the aggressive rate hikes needed to tame that have now materialized. Avoiding a hard landing would be historically unprecedented. Now, of course, we've heard the Federal Reserve Bank say that 1, a recession is not going to happen. 2, if we see a recession, it's going to be a soft landing. And then 3, now what we're hearing them say is a mild recession is now the base case. And what Deutsche Bank is essentially saying is, we have all this inflation because of the money printing. It's not because of greedy corporate profits. It's not because of other things. It's because we printed so much money. We threw this money into the economic system. All this money printing devalued our dollar. All this money caused so much demand from people to buy things. All this demand from people to buy things caused the prices of things to go up. And now we're trying to correct this problem. We have raised interest rates so aggressively over the last 18 months. We're still probably going to see another interest rate hike or 2. Deutsche Bank says we're going to see at least 1 more interest rate hike. And this rapid run-up in interest rates is going to have a consequence. Just look at history. They're saying historically, anytime you see interest rates rise this quickly in the past, you are going to have what they call a hard landing. And a hard landing essentially means you're going to see economic pain or some sort of recession. The second thing that Deutsche Bank talks about is consumer spending, and more particularly the future of consumer spending, because what Deutsche Bank says is that right now there's still a lot of excess money floating around out there from the COVID stimulus. Now, this is not just stimulus checks and unemployment checks, but all the money that was printed in 2020 and 2021, which was injected into the economy to businesses and other places, which is still floating around out there, which Deutsche Bank says still needs to be processed and put through the economy. Right? The reason why the prices of things can go up so much is because people still have the ability to pay the higher prices. Because if people can't afford to pay the higher prices of groceries, then groceries can't keep going up in price because, well, people won't be able to pay it. Just like that, it's the same with housing. If people can keep affording to pay the higher prices for homes, buyers will keep raising the prices of their homes. Just like that, when people can keep affording to pay the higher rent prices, landlords are going to keep raising the prices of their properties. This is the way that it has worked. And what Deutsche Bank says is that there's going to be an end to this coming soon, because all this excess money out there is going to hit a breaking point, and they're projecting that it's going to happen by the end of 2023, closer to October of 2023, where consumer spending is going to hit a breaking point where people are going to struggle then starting to pay for the higher prices. Now, of course, we still have the high inflation around. They talk about that in point number 5. But now when you mix the higher inflation with the reduced savings, the reduced creditability, meaning people are going to be maxed out on their debt limits, well, that's going to create that slowdown in consumer spending, which will also hurt the economy. Now, we've done full deep dives of this on Market Briefs. Market Briefs is my free financial newsletter. If you have not joined Market Briefs yet, it's an easy and free way for you to stay up to date on what's happening in the economy, in the housing market, in the stock market, in the global economy, with a fun, witty, and easy to read email. You could read this email in less than 5 minutes every morning, and it's completely free. If you have not joined Market Briefs yet, you can go to briefs.co/market. That's briefs.co/market. And I also got the link for you down in the description below. The third factor that Deutsche Bank talks about is unemployment rates. And what they're saying is that unemployment rates are going to rise. They said that right now unemployment rates are around 3.7%. They're predicting that by the end of 2023, unemployment rates are going to rise to around 4%. And then in the first few months of next year, 2024, they're predicting 4.5% unemployment. So what are they saying? They're saying that now when the spending starts to decrease, that's going to mean that businesses make less money. When businesses make less money, that's going to cause more layoffs, more bankruptcies, which means unemployment is going to go up. And obviously, that's going to have an impact on the economy. The fourth factor that Deutsche Bank talks about is economic growth, and more particularly, the slowdown in economic growth. Now, obviously, we're already seeing the economy slow down in 2023. We're seeing the economy grow slower than expected, and they're saying that this is going to continue, and that in 2024, we're actually going to see an economic contraction. So our economy is not going to grow, it's going to shrink, and that's where we're going to see more pain, because now as the economy shrinks, that means people are going to have less ability to spend, especially now because of such higher prices. So you have less incomes because businesses have to do layoffs, and then at the same time we have all these inflated prices, which then people with less incomes have to pay for these higher prices, and that's going to cause an even bigger correction in the economy. And then the fifth risk factor that Deutsche Bank talks about is the high inflation. Now, of course, we still have high inflation. CPI has fallen off of its highs, but it's still very high. Core inflation has fallen a little bit off of its highs, but it's still very high. Meaning inflation has fallen, but it's still there. Now, let me remind you, inflation, when it's coming down, does not mean that the prices of things are falling. It means that the prices of things just are not growing as fast. So over the last few years, we have all this built up inflation, meaning the prices of things have risen so quickly. And now the prices of things are still rising quickly, just not as fast as they were before. And the Federal Reserve Bank is working to slow down the price growth of things. Again, they don't want deflation. They're not asking for the price of things to fall. That's what they don't want. What they want is the prices of things to not rise as quickly. So you still have all this built up inflation, and it's still going to take more time for inflation to ultimately come down to 2%. Deutsche Bank talks about that. And then they say, well, this all ties together. Because in order to bring inflation down to this 2% target, the Fed is going to have to keep raising interest rates. And you can start to see now the higher interest rates cause more economic pain. It causes more layoffs, and it causes a slowdown in the economy. But that's what it's going to take to cool down inflation. And this is where Deutsche Bank is saying, a lot of people are saying, well, we're seeing this boom in the stock market, or we're seeing this happen or that happen, or unemployment is still low. Deutsche Bank is saying, well, look out the next 6, 12, 18, 24 months. That is going to cause economic pain. The economic pain is still coming, and you need to be prepared for that. And this is where now your job as a financially smart person is not to be panicking about what's happening, but rather be aware of what the possible scenarios are. That way you're not blindsided by things, but rather you can capitalize on opportunities, because the reality is recessions create more millionaires than any other time. Why? Because recessions also mean that good assets can sell for a discounted price. But in order for you to buy these investments at a discount, you need, number one, the financial education to know what it is to buy. Because when most of the times asset prices fall, when most of the time stock markets fall, when most of the time real estate prices fall, people run away. They don't buy. So you need the financial education of know how to find a good investment, how to analyze it, and know what to buy. And then second, you got to be prepared. You need the money to actually be able to buy. Now, how do you do that? That means you got to prepare today. Like what I say is 2023 is not the year for you to go out and finance a new truck. 2023 is the year for you to get financially smart, which is now where you're working to spend less money, stop blowing all of your money, and work to earn more money. That way you have more money to invest. And even if you're not ready to invest right now, start building up this cash pile. That way, number one, you have savings to protect you against an emergency. And then number two, you have cash there ready to capitalize on investment opportunities that might come your way. And the only way you can capitalize on them is if you have the money to do that. And that means you got to get prepared now. Most people start preparing when it's way too late, but you want to prepare when times are okay. That way you can take advantage of opportunities when times are not okay. But that requires you to start building that financial education and getting prepared now. There's been a lot of talk recently about the real and root cause of inflation, where you've had a lot of media articles saying that corporate greed It's what's causing inflation, and it's the reason why inflation is still here, and it's the reason why inflation is not going down. That corporate greed, wanting to maximize their profits, is why we are seeing